warns that investors still have to be cautious until the Fed slows its rate hikes. For more, let's welcome in Mark Avallone. He's president at Potomac Wealth Advisors. That's kind of what Bob was just describing. Mark, what would you like to see the Fed do or say that would make you feel more bullish right now?
Good afternoon. Exactly what Bob was just finishing up with on the bull case. It's a delayed bull market in my mind. I don't want to be out there today. I'm not diving in. And I think investors need to be cautious until we have the July inflation and then the August inflation and that September Fed meeting. But I do think the optimistic investors will be rewarded later in the year. And what's interesting is what I've noticed is growth stocks have been outperforming those defensive names and those value names the past month. And the difference is significant. And I expect that to happen in a slowing growth economy. I think people can start to look at growth names, tech names for long-term vision. Cash flowing tech is a solid consideration.
So, and we were having this debate yesterday with Charlie Babrinskoy, who's sticking with the value names and says they will continue to outperform. Why don't you think that'll be the case?
Well, they haven't outperformed in the past month, and that tells me that when people believe it's going to be risk on, or we have a more benign Fed, and we have inflation tapering, that those are going to be the companies to invest in. I think we might look at some earnings pressure from a stronger dollar relative to the euro especially as a headwind for technology and growth names. But I think as we look out in a slow growth world, that's where money goes. When you want top line growth, when the world is slowing, that's where you invest, not in defensives.
Okay. That said, talk to me about the financials, which are one of the three general buckets you like here. But I know it's the insurers in particular you favor. What about the rest of the space, especially after what we heard this morning?
Well, we asset allocate, so we're not totally on one side of the growth boat. And in the value space, we do have financial exposure. The reason I like insurance companies, despite today they're doing quite poorly, I think, on the JP Morgan news, is that they're going to benefit in this higher interest rate world. They're still getting hit. Their bond portfolio's getting hit. The benefit to higher rates for their huge balance sheets hasn't come through. So there has been a lag, but their multiples in the mid-single digits are incredibly attractive. I think the problem with banks is what we're seeing today, and we're not even hearing that asset value declines are going to hurt earnings in addition to the investment bank earnings declining. But the biggest factor impacting banks is always loan losses. It's been so long since we've had a recession, since we've had loan losses, investors forgot. The pain of loan loss reserves, the pain of realizing losses is far greater than the gain from higher interest rates and gross revenue. And that's what's hurting JP Morgan today. And that's what concerns me the most about direct investments in banks.